Um, Hello, everybody. Good afternoon to you. My name is Tracy Sumstead. Thank you all very much for joining what I think is probably our 8th or 9th webinar. Our lovely Adrian is going to do the presentation today because he loves these so much and I tend not to. I get all tongue-tied and twisted in these things. So Adrian has a vast knowledge of hands-on experience when it comes to dealing with pensions, and he's also a tax accountant. So that's very beneficial when it comes to dealing with this particular area. So without further ado, Adrian, I'll hand it over to you.
Thanks, Tracy. Hopefully everyone can see the same slides. If it looks like I'm kind of looking over here, I have two screens going. I'm just trying to make sure that you're all watching the right one. So hopefully that's it doesn't get too confusing for us.
Actually, Adrian, just before you start there, I should probably just cover off that, it is a generic presentation and obviously the details on it are not specific to anybody, individually. But there is a question and answer box on the bottom. Well, certainly on the screen I'm looking at here, it's on the bottom. So at the end of this session, we'll go through and answer any individual questions. We've already had a few people email in some questions, so we'll answer them. We'll cover them off as well.
Great, thanks, Tracy. So yeah, I suppose as Tracy mentioned, my history is that I'm a qualified tax advisor, accountant, and financial advisor. So I suppose when it comes to pension season, I typically have been involved in this for the last 20 odd years. So I suppose what I want to just kind of do is just touch on a couple of things over the next half hour or so, and hopefully it'll trigger a few things for a few people. So give me just a minute and I just make sure that everything is going the right way. Sorry, now 2 seconds. Okay, hopefully that's still the right screen you're all seeing. So what we are looking at is really just kind of retirement income in general, right? So the current state social welfare pension is 248 a week, or 12,911 a year. For a lot of people, there's a massive drop coming from what they're currently earning on an annual basis down to that 13,000 figure. And the big question is that enough for you to live on? Okay, for most people, you're not going to have any mortgages left at that stage. Hopefully, you're not going to have any kids in college. Hopefully, at that stage either. But really, is coming from what you're earning right now down to 250 euros a week sufficient? Is it going to be enough for you into your retirement? So there was research done there a couple of years ago. So 87% of the Pensions Board consumer research sample said that the state old age pension would not meet their needs in retirement. So that's hugely pointing to the fact that they recognize that they need to have some form of private scheme in place as well to actually make sure that they can get enough of a retirement income for themselves. So pension season, what is it? I suppose every year you see this mad frenzy being issued by media. There's huge ads constantly on the go just in relation to what pension season actually is. Really what it's in relation to, it ties in very much with the 31st of October income tax deadline. Okay, so what the income tax deadline is relates to is individuals who pay and file their tax returns through the Revenue Online system. They have until the 17th of November to do it online, but for everyone else who files a paper return, it's the 31st of October. Traditionally, it used to always be the 31st of October. It's still known as the 31st of October for pension season, albeit that anyone who files online has until the 17th of November to actually contribute to a pension scheme and to backdate that contribution for income tax relief purposes to the 2020 tax year. So if you were a proprietary director or something like that, and you're filing your tax return now, or if you're a self-employed plumber, you're now filing your tax returns and you can make a contribution back to that 2020 year for tax purposes. It also applies to people who are contributing to PRSAs or AVCs. So if you're an employee of a company scheme with considerable relevant earnings, you can actually use this and avail of the income tax relief by contributing now and it'll be just reclassified as a 2020 contribution. So you have again until the 31st of October or the 17th of November if you're going to do your pay and file online through Revenue's ROS system. The one thing we always say to people is, look, if you have a tax liability, look and see what you could pay into a pension and see how much of a difference it will actually make to you. In our view and in most people's view, it does make sense to pay it to yourself rather than actually giving it to Revenue. Not so sure Revenue would have the same opinion, but they do allow for this. So it's something that people should look at. Okay, why have a pension? So I suppose, again, we've mentioned that the current state pension is only short of 13,000 a year. So what you're trying to do is you're trying to provide yourself with a regular income to replace your earnings while you're in retirement, or if you have to go out on early retirement due to ill health. So what is the gap between that 12,911 and what you were earning? It also does help to provide a lump sum benefit for surviving dependents. So if you have a pension built up, it can be used as a way of passing assets onto your spouse and your children in death. There are obviously tax reliefs, as I've mentioned. So these are income tax and PRSI relief on the employee contributions. There's no benefit in kind on the employer contributions. So if you're in an employer-led scheme, there is no BIK on those contributions from your employer unless it is paid through a PRSA scheme. There's not that many PRSA schemes kind of left out there where the employers are contributing to them because of this benefit in kind issue for employers. Pension schemes do not have to pay income or capital gains tax on any investment returns. So basically it means that the growth within your pension pot is tax-free. So if you put in 100,000 over a number of years and that grows to 150,000, there is no tax on the growth within your pension scheme. And again, part of your retirement benefit may also be paid out as a tax-free lump sum. I do go through a little bit of that later on. But again, it's just a way of accessing tax-free cash when you do get to retirement. The different types of pensions, I'm going to run through these very quickly. PRSAs, personal pensions, self-administered schemes, executive or company schemes, and AVCs. So the PRSA, just in general, this is a standard enough scheme that was set up back in the early 2000s. And what it was designed to do was to allow a very simple off-the-shelf product for homemakers as well as for all other people. Basically, it didn't require you to be in any employment. You could actually set this up and continue to save to it. There's no minimum amount you have to pay into a PRSA. And the charging structures for this are very, very transparent. They were designed as a very transparent structure. So for a standard PRSA, there's a maximum annual management fee of 1%. And a minimum of 95% allocation rate. So what the allocation rate means is if you're putting in 100 euros a month, there's at least 95 euros of that going into your pension scheme. So when these were set up in the early 2000s, there was a myriad of other charges that were apparent and visible. Now it's much more streamlined. It's much more clear in terms of what type of structure you're going into. So the PRSA structure in and as of itself is not as good as what it was when it was originally set up. And the other side of that as well is you're very limited in terms of the funds that are available within a standard PRSA. Again, this mentions that there's also a product called a non-standard PRSA. But for many people, if you're looking at a non-standard PRSA, you're probably talking about one of the other products being more suitable to you. Personal pensions, again, this is something that's really for sole traders. It's a policy both you and your business can contribute to and receive tax relief up to your marginal rate, whether that be 20 or 40%. There can be minimum contributions required. For most companies, those minimum contributions would be about €100 a month that they would look at. Charges are deemed to be lower on personal pensions when compared to PRSAs, but that again may not always be the case. The devil is in the details. So it's all about kind of reading through it and understanding from your advisor what structures are in place, what management charges, all of that are in place in relation to it. When investing in a personal pension, you will be risk assessed to see your attitude to risk in investing with pensions. That's going to be the same for most of the pensions, especially that we look at for clients. What you're trying to do is identify where you as the client sit on a risk rating. So are you, so the scale runs from 1 to 7. So are you down at a 1 where you're literally sleeping on your money? Or are you up at a 7 where we're all in Vegas putting it on black? And for most people, that is going to be somewhere in a 3, 4, or 5 is where you're going to end up. So it's very important for us as advisors to understand where you're actually at, because that helps us put together a portfolio of funds that's going to be that's going to match your attitude to risk. So if you're dealing with someone and they haven't done a risk assessment on you, then it is very important that you actually review the types of pensions that you're in, review what you're in, review what funds you're in, and make sure that it is actually suitable to you. Self-administered pension schemes. These are very not as common as probably what they used to be. They're designed to be used really by experienced investors. Experienced investors with large pots of money is really, I suppose, the way I would describe them. What they were mainly used for in the past is someone who had a rather large sum of money who wanted to acquire property into their pension. They would be done through a self-administered pension scheme, and the property is bought through the pension. All of the rental income and all of that comes into the pension. The property, if it's ever sold, all the money stays within the pension. It must be remembered that it can't be used by you as the owner of that pension scheme. With the self-directed pension, you decide what your pension is invested in. So it can be invested in property. You can decide to invest in specific shares. You can go and buy Ryanair shares, or if you bought Pfizer shares and all of that maybe 12, 18 months ago, those types of things is really what you're looking at. The charges on self-directed pensions are typically higher than on regular private pensions, executive pensions, or PRSAs. And again, that's because the type of property or the type of investment you're in is quite different. The administration costs on it are quite different from a standard product that's out there. They are, as the title suggests, very much self-orientated and very much designed, bespoke designed products. Executive or company pension plans. So these are I suppose the one that most people would be aware of. So you're a member of a company scheme, or you're a director and you have a company scheme. So they're often used and are the most popular choice for business owners or directors in preference to a PRSA, again, because of the charging structure and the investment opportunities. The benefits are much better from that side of things. Despite the name, they have a very different legislative status to personal pensions. They're best thought of as occupational pension schemes for a single person or for a small group of individuals. So again, we would work with a large number of companies that would have 2 schemes running. One would be for the staff, we'd say, the general staff of the company, and the second one would be for the executives of the company. So that would be either the senior managers or the directors or that type of thing, where the investment structuring within them can be much more bespoke to the individual involved. Because they're a type of occupational plan, an employer is required, so it would have to be done. It's typically done by limited companies for their employees or their senior employees. A sole trader can become eligible for it by incorporating, as we've said, But you can do it as a sole trader for your senior managers. So it wouldn't be that you could do it as a sole trader for yourself. But again, as I said, it's available there. You can do it through. You can do a personal pension or a PRSA for yourself as well. So with an executive pension, just to continue a little bit on about this, it is set up under a trust, and trustees are required to be appointed. In some cases, they can be arranged independently at a cost to the company sponsoring the scheme, or some life companies offer this benefit free of charge. What we typically try and do is to actually work with the life companies ourselves in relation to getting this provided free of charge to our clients. It is something that they all will do. It depends on the level of or the number of employees within the scheme and the level of contributions going into the scheme, but it can actually be quite beneficial to an employer. So if you're contributing to an executive plan, and this kind of goes in relation to your personal pensions as well, your contributions are restricted by your age and income level. I'll go through those figures in a little bit as well. Contributions are eligible for relief from income tax. One of the important things to remember, and again, I'll go through the contribution limits in terms of how much you can, as an individual, depending on your age, put into your pension. It's important to remember that if you're in an executive plan, your employer is still able to contribute more. So if your contribution max as an individual is, let's say, 10,000, there is absolutely nothing stopping your employer scheme or your employer contributing maybe 20,000 to that. It's not going to actually impact on your personal contribution levels. So for a lot of self-employed directors and senior executives, this is a fantastic way of getting an additional payment from the company, albeit into their pension schemes. The rules governing total contributions to executive pension schemes are intricate. So again, this is one of the things we look at for a lot of clients is this max funding. So you've had the company up and running for maybe 15 years. Realistically, you've only been properly making money in the last maybe 7 to 10 years, and you've only really been contributing to a pension over that period of time as well. So what we do is we run this calculation known as a max funding calculation. And what it will do is look back over the last 15 years and say, well, actually, you could have contributed X amount over those 15 years. So we're now allowing you, or calculating what you could contribute in one full lump sum. It does work in terms of turning the company profits into almost personal wealth in a very tax efficient manner for a lot of proprietary directors. So that's something we do for nearly all of our company-led executive plans. If you're a director of your own limited company, you can have the company fund the pension again without any personal contributions. So if you are the director and you want to contribute 50,000 a year into your pension scheme, the company can make all of that contribution, and zero can actually come from yourself. There's no requirement for you to fund it at all. So this is a quick calculation I ran on, or a kind of an outline of the max funding, and then I'll run a quick calculation for you as well. So the maximum pension that can be paid from an occupational pension scheme is about 2/3 of your final salary. So including existing and all retained benefits. So retained benefits are pensions that you might have had with previous employers back along the years. Funding calculation uses a set of factors specified for revenue for approval purposes. They do not necessarily replicate real market conditions year to year, and so they need to be ran on a regular basis to actually make sure that your figures are correct. The calculation indicates the maximum contribution options allowed for approval by revenue. If the limits are adhered to, the contributor should be able to secure tax relief on the contributions made. If they're exceeded, it is within the discretion of revenue to impose adverse taxation consequences. So effectively what revenue would look to do is unwind the scheme if they feel it has been, if the rules have been breached on the way in. In most cases, what you typically do is if your funding calculator produces a figure, you try and keep just below that, so you're actually making sure that everything is safe from a revenue perspective. So we'll run a quick example. So Mary, a 50-year-old who is an employee and director of a company, she has a salary of 60,000 and previous retained benefits of 120,000. So basically what that means is her current pension value between everything is 120,000. When she reaches retirement age NRA of 66, she'll have 26 years in total of service completed. Using the max calculator that's available, she is allowed a fund of 884,000. So we run the figures in the background. It produces a max fund that she can have of 884,000. So she can either do a one-off single contribution now of 266,000 with ongoing annual contributions of 38,000 from the company into her scheme. Both can be made by the employer. Now, one of the things that needs to be remembered here is while both avail of tax relief, it is over time. So the company, if the company makes that contribution of 266,000 in one go, it will be able to claim the tax relief over a 5-year period in relation to that. So while Mary gets the money now, the claim will actually only be done over a period of time. It is an efficient use of company money, as I've outlined before. So again, Mary is able to take 266,000 out of the company now to contribute to her pension scheme. So that 266, together with the 120, plus the ongoing contributions of 38,000 a year, should get her to a stage of being at a fund of 884,000 when she turns 66. So again, we would work with a lot of companies in relation to coming up with that figure, especially in a situation where a director is looking to retire over the next couple of years or to exit the business over the next couple of years. So we're working on a situation at the moment where we have a client who is looking to sell their business. It's a very cash-rich business. We're working with them to identify what they could contribute to their pension scheme and avail of basically you're taking the money out of the company so that on a future liquidation of the company, that money is not there and is not subject to capital gains tax. For that client, it's actually working out as a figure of 635,000 that he can take from the company right now and put into his pension. So it is a massive benefit and efficient use of companies' monies for directors. AVCs are additional voluntary contributions. This is something that's available to all employees. So if you are in a company scheme or in an executive pension plan, you can actually make use of this. So you have the ability to make AVCs. If you want to make that AVC, again, it has to be done in line with our 31st of October and 17th of November deadlines. So if you're looking to claim that tax relief in relation to 2020, the contribution needs to be made in the next couple of weeks, and you'll be able to backdate that contribution and claim the tax back on it. It's also available if you're in a defined benefit scheme based on your salary and years service. The defined benefit scheme ones do require a little bit more calculation and a little bit more time to be organized in relation to those, but it can actually be done. So essentially, you might be able to top up your pension to get the maximum available tax relief, lump sum and monthly pension when you retire. So again, we can run the figures with you and see, well, what is it that you're actually that's available to you in the future, and what could you have available to you in the future, and produce a calculation of what it is you could contribute now to work towards getting that maximum benefit. One of the things to remember just in relation to the contributions, if you do make an AVC contribution in the next couple of weeks for 2020, make sure you do claim it on your tax return over the next couple of weeks as well, and then you will get the tax benefit for that. So I suppose the pensions and tax season, I've just outlined the date there again. So any contributions up until the 31st of October or 17th of November can be backdated to 2020 for income tax relief purposes. And that's available even if you haven't previously set up a pension. So you could be a self-employed individual and have never had a pension. Your accountant is coming along to you now with maybe a significant tax bill. You can look at setting up a pension now, making a one-off lump sum contribution to it, claiming the tax relief, reducing your tax liability for 2020, and now you have a pension in place. You can contribute on a regular basis to that, or you can go with one-off lump sums on an annual basis. Obviously, for I suppose getting the best out of your pension, it would be more important that you do a regular monthly contribution, because it just smoothens out any the various prices that you're buying into your pension at throughout the year. But again, we can explain that in more detail for anyone who's looking at that. Again, the employees can make the ABCs and avail of the benefit of the tax relief for those previous years as well. Sorry, previous year. So these are the maximum contributions. So if you have someone who's up to the age of 29, they can make 15% of their net relevant earnings. Typically for most employees and self-employed individuals, that is going to be either for self-employed individuals, it's going to be the net profit for the year. For employees, it's going to be the earnings for the year before the gross earnings used for universal social charge purposes. There are some nuances around that, but again, your accountants can actually calculate that for you quite quickly. So up to 29, it's 15%, and all the way up to the individuals over 60 who can contribute 40% of those net relevant earnings on an annual basis. So the scope is quite large in terms of what you can contribute. There are some other revenue rules in relation to the max salaries that can be used, the max earnings that can be used, and the overall max fund that you can have in place. But again, it won't apply to that many people, so we typically don't cover that off. So we've a couple of examples here. Lisa, who's a vet, 35 years of age. So her earnings for 2020 are 65,000. Apologies if this is quite small. When I was doing it, I thought it was bigger, but when I see it on the screen now, it's a little bit smaller. Her max contribution limit is 20% based on her age, or 13,000 euros for 2020. If she invests 13,000 into her pension, she can claim relief at 40% against her income tax liability for 2020. So because she's already over the 20% standard rate, she's into her 40% tax rate. That's her new marginal rate, so she can claim it all at the 40%. So if she does a max contribution of 13,000, her net contribution, so after tax relief is applied, is 7,800. So again, there's a significant saving there for someone who's still considered quite young at 35 to be starting a pension. So second guy here, Michael, is an employee at 45 years of age. He's currently a member of a company pension scheme. His salary for 2020 is 80,000, and however small the last writing was, this one is much smaller. So again, sorry about that. Current contribution, the employer makes a contribution of 8% of his salary every year. So it's 6,400 comes in from the employer. He contributes 10% of his salary, so he's contributing 8,000 a year. And he's looking to contribute to an ABC to reduce his tax liability for 2020. His max contribution is 25% of his earnings, or his net relevant earnings of 80,000. So 20,000 is what he can contribute. He must make this contribution before the 31st of October, or again, the 17th of November if he's filing online. And the max amount he can contribute is 12,000. And simply that is his overall maximum contribution of 25%, or 20,000 euros, less what he has already contributed. So he can make a contribution of 12,000 before the end of the month, before the end of October even, and he will be able to claim tax relief on that. So his net contribution then comes in at 7,200 for Michael. So one of the things I just wanted to go through quickly was things to look at in terms of setting up a pension for yourself. So if you've not set up a pension for yourself before now, and you are thinking of looking to do one for the tax relief that's available on it, you need to look at the service provider who's actually going to be working with you on this. Whether you go to a company directly or whether you go through a broker, you need someone who's actually going to provide a good service to you overall in relation to your pension. The management charges is another huge thing to be mindful of. You know, pay peanuts, get monkeys, I suppose is kind of one of the things that needs to be remembered here. I'm not saying you need to be paying huge management charges to avail of you know, the advice that's out there, but you certainly need to be just mindful that you're not overpaying management charges for no advice, or that you're not underpaying on your management charges and receiving no returns. So there is that happy medium in there that does need to be looked at. Allocation rates, again, this is a huge thing. As I mentioned with the PRSAs, there's a 95% allocation rate. That means 5% is taken by the provider in charges before it even goes in. Typically with any of the pensions we would set up, excluding the PRSAs, there is 100% allocation. So if you're contributing 1,000 a month into your pension scheme, 1,000 a month is going into your pension scheme. So again, just make sure that whatever provider or broker you're using is doing the same thing, that the allocation rates are correct on that. Policy fees, again, this is all to do with the management charges. Check your policy, see what kind of fees you're actually paying within there, and make sure that it's I suppose it's level with what the rest of the market is offering, that they're not excessive fees. The other big thing is the fund choices. I mentioned it earlier when we were talking about risk and risk rating. It's hugely important that you watch what funds you're invested in. And again, this comes down to your service provider. You have to make sure that the funds you're invested in are suitable to your risk attitude. There is no point in you being in 100% equities when you're an extremely conservative investor. You have to make sure that what you're invested in suits what it is you're actually doing. You'd be delighted to know we're almost there. The last things I just wanted to cover off with just some retirement options. So at retirement, you would be entitled to either to a lump sum, and that lump sum is tied to your final salary in the relevant employment and your years of service, or 25% of the value of your accumulated fund. So if you have a fund built up of €1 million, in theory, you can access 25% of that on retirement. So that gives you 250,000 tax-free lump sum. So again, it's a massive boost to your retirement at that point, where you can access that straight away. The first method will apply if you're taking the balance of your benefits as an annuity. There's not really that many people taking annuities anymore. And I suppose the reason for that is annuity rates are really, really poor. So you're looking at an annuity rate of maybe 2.5 to 3.5% per annum. So again, if you start off with 100,000, you're really only looking at taking 2.5, 3,500 a year out of your pension. It's not really a huge amount. The second portion, or the second option, is to use the balance of your benefits to purchase an approved retirement fund or an approved minimum retirement fund, more commonly known as ARFs and AMARFs. These are, I suppose, the most common method used by most people on their retirement, in terms of the ability that they have to use their funds correctly for future uses. And those future uses will actually include passing the assets on to children. You can't do that through an annuity. You can only do it through the ARF or AMARF. In either case, the maximum tax-free lump sum entitlement you will have is 200,000. So while I mentioned earlier on, technically, or in theory, up to that 250,000, it is capped at 200,000. So just bear that in mind. We've already gone through the ARF and the AMRF. There are some nuances, again, just in relation to how those are structured, but again, that can be explained when you reach retirement. In certain circumstances, the balances after your tax-free entitlement can be taken as a taxable cash. it's normally where the sums are quite small. You know, after you've taken your tax-free lump sum, if that sum is quite small that's remaining, then you can actually access it. So I think that is pretty much it from me. So I'm going to ask Tracy if she'll just come back on and we might cover off some of the questions. I know that there was quite a number of questions pinging on my side here anyways, while I was going through it. So we might just look at those.
So yeah, just while I read out one or two of these, if there is any other questions, that please, yeah, write them in the question and answers box or even the chat box there, and we'll be able to see them come up straight away. We've had some yeah, really quite good ones here, Adrian. The first one would be why do allocation rates vary when it comes to PRSAs?
Okay, so the standard PRSA allocation is going to be 95%. So typically when you see a PRSA, you automatically know that 95% of my funds are going to get invested. It's just, it was the way they were established. It was the way that the Charlie McGreevy was the one who kind of established these back in the day. And that was kind of how they were just structured. It was to have a clear charging structure in place on them. The non-standard PRSA, as I mentioned, is kind of like your personal pension, your executive pension, all of that. And the allocation rates do change. But as I said, it's important to be just aware and sure of what it is that you're actually that you're getting into when you're setting up one of these schemes. But the standard PRSA would it's just the way that they were created, that there was a 95% allocation.
Great, thank you. And then okay, how do I rephrase this one, because it's about specific circumstances and I don't want to give too much details away.
Well,
so
I think I know the one that came in, so I might just cover it off. It was actually to do with the contribution limits. So if you had, I'm just trying to scroll back up through my slides here just so I can see it. Of course, I can't see it now when I need it. So remember I was saying that but I really can't see it. Where did I put that slide? Here we go. So the maximum pension contributions as a percentage of your net relevant earnings is what this person was asking about. So if I just do this and that, okay, can you see that slide now?
Yeah.
Okay, so the individual said, okay, if I turn 55, do I start that contribution? So middle of the year, I turn 55, I'm now at the 35% contribution bracket. Is it from mid-year on, or is it for the whole year? And actually, it's the wording in the legislation says, in the case of an individual who at any time during the year of assessment was the age of. So if you turned 55 on the 31st of December 2020, you actually can use the 35% contribution limit for the whole of 2020. So I think that hopefully will answer the question for that individual. It was quite a specific one, but it is the year of assessment. So if at any stage during that year, that's when it applies from.
Yeah. Is there, one other question here is there any other options aside from the ARF or the AMARF when it comes to drawing down pension funds?
So as I mentioned, there are three options. One is the ARF or the AMARF route. Two is an annuity, which is something else that's there. Annuity rates are not great at the moment. As I said, the annuity rates are really, really low. If they were better, then it might be an option for you. The one thing to remember with the annuity is that on your passing, unless you have a spousal benefit built into your annuity, and by building in a spousal benefit, it means that on your passing, your spouse gets X percentage of what you were getting. If you do that, it reduces even further your annuity rate that you're getting. And if that happens, so if you pass away, in my situation, it would go to my wife. If she then passes away, the value of funds remaining is gone. it's with the life company that you bought your annuity from. Okay, so it's not something we typically advise clients to do anymore, unless they're on older schemes that have very, very good guaranteed annuity rates built into them. But typically, there's very few of those remaining. So short
Or no
answer,
children, or nobody that want to leave money to.
yeah, exactly. I mean, there is that case, that you would have. We had a client in with us there recently, and she has no children, she has no spouse. But does she want her money to just disappear into the ether? No. I mean, when you kind of actually go through it with a client, they will see the benefits of, yes, it's better to go to the nieces and nephews than no one at all. So no, unless they don't have nieces and nephews, then you're kind of into a whole other world of it. And the last option, as I mentioned, is this tax-free, or not tax-free, the ability to withdraw the full amount in one lump sum. And that applies if the remaining fund is under 30,000 euros. So after your tax-free cash has been taken out, if your fund is under 30,000 euros, then it is taken out subject to tax. Those are really the only three options, unless I've forgotten something, Tracy.
No, I think that's it exactly. And then last but not least, is somebody was just looking for confirmation that in relation to obtaining the maximum tax relief in a company scheme, does the employer's contribution count or not? They just wanted clarity on that.
No. So again, if we go back to my wonderful slide here while I have it still open. So if you have, for example, you're over 60, let's make my figures much easier. So your employer is putting in, you're on a salary of 100,000, you can contribute 40% of that, or 40,000, and your employer is putting in another 30,000. That employer contribution of 30,000 does not impact your contribution limit, so you can still do your 40,000. So it's a massive ability, on companies and employees' behalf to actually really go for the maximum limits that they possibly can on this. The more you contribute to your pension, the more that's there when you actually retire. Now, I accept there's going to be a number of people who can't contribute to the maximum levels. Certainly not in the earlier years, not if they have mortgages and children and all of that kind of thing. But as you and I both know, Tracy, it is really important that people look at what it is they can contribute. And remember that if they're looking to take 100 euros out of their wallet and put it into their pension scheme, in most cases, that will actually be a hell of a lot more because of tax relief.
Yeah.
That's 100 euros net. That'll be 150 or more going into your actual pension scheme. So it really, really is important that people look at what it is they can actually contribute out of their back pocket. That's really what you need to be looking at.
I think typically, when you're meeting with these clients, the closer to retirement age an individual is, the more aware or conscious they are. But unfortunately, there's so many people that, that wouldn't necessarily be approaching retirement age that are missing out on the opportunity to be able to avail of all these tax reliefs. So again, it just be really important for anybody to, to speak to an advisor and find out what your limits are, so that you can make the most out of that tax relief system that's there to all of us here in Ireland. So yeah.
I just wanted to run a quick figure. So if you're looking to pay into a pension scheme, let's say you're looking at 200 euros a month going into your pension scheme, to work out kind of how, what that would be gross going into your pension scheme. This is going back to algebra. Solve for X. So 200 would be 60%, because that's the net figure after the tax relief. So you just regross that up. And it works out that it would be almost 330 euros, 333 euros going into your pension scheme, but only 200 coming out of your back pocket. Yeah. So there's a huge benefit in that. There's another 133 that you didn't have that's now going into your future fund.
Yeah, absolutely. And one thing I would just like to say is that when it comes to, to individuals that are approaching that retirement age, it would be really important to, you know, to try and set aside as much as you can into your pension fund, because that horizon is closer. For example, somebody in their mid to late 50s versus somebody only in their mid to late 20s. So again, just try and maximize it on all the reliefs and all the entitlements that are there for us.
Yeah, exactly.
Now that's all the questions that I can see here. I don't know, was anything specific come in on to you directly, but I can't see anything else here.
No, that was it. That was it.
So listen, everybody, thank you very much for attending. Adrian, oh, hold on. Someone else
There is one
here.
here. So it goes in tax-free, but you're taxed when you take it out. Yes,
yeah.
Absolutely. But it's all then about how it's planned on the way out. So if you're contributing to your pension scheme, as I mentioned, you will be entitled to take 25% out tax-free. And then the rest of it, yes, it is subject to tax, but it can be planned to at least keep it at the marginal rate or your lower rate of tax rather than a 40% rate of tax. So yeah, but remember, the growth hasn't been taxed within the fund at the same time. Okay.
As an individual from the age of 65, you're entitled to 18,000 a year income before being subject to income tax. So like what a lot of people would do is obviously they have their state pension, then they use their ARFs or their AMARF and draw down enough income to complement their state pension to give them a level of income that they're, you know, they're comfortable with, and their cost of living is good. So again, they would just be mindful of those tax brackets. So yeah.
And you can choose, if you use the ARF AMARF route, you can choose what you want to draw down. Now there is a minimum that you are required to draw down once you retire and reach the age of 60. So you have to draw at least 4% a year out of your pension. But if that depending on what that figure of 4% is, you can choose to go 5%, 10%, or 15%. After that, it becomes, it's your money. The choices are yours in relation to it.
Yeah. So I think that's it. So
yeah,
thank you, everybody. Yeah, thank you, Adrian. Well done.
No problem.
Another one done.
Yeah, exactly.
Do you want to put up your last slide again so that your contact details are there? So if anybody has any questions or would like to reach out, then they can do so at their own discretion.
Yeah, I can do that. I just have to try and figure out how to get there. There we go. There we go. So if anyone has any questions or queries, please contact us and we can go through those. Okay.
Great stuff. Thank you, everybody. Take care. Bye now.
Bye.